In this video, I'm going to talk about the pre-qualification and pre-approval process in terms of what regulators don't fully seem to understand about that process. So if you ask most mortgage professionals what's the difference between pre-qualification and pre-approval, the answer you'll get is that a pre-qualification means that the loan officer has just spoken with the borrower to find out about their financial situation, whereas a pre-approval means that the consumer has submitted their financial documents for review. Certainly, that process of going through pre-approval is much better than pre-qualification, yet we find that many so-called pre-approved borrowers end up getting denied in underwriting. Now, consumers are aware this can happen. Real estate agents are very concerned, especially when they're dealing with a lender who they haven't worked with before, that this pre-approval may in fact not close and damage their reputation, damage their income. So today we're going to discuss a little bit in more detail about what causes so-called pre-approved loans to fall out in underwriting. There are essentially four basic reasons that a pre-approved loan will not close. One is if the borrower did not give accurate information about their financial picture. And even in a pre-approval, something like the appraised value of a home that they've provided, that they're either refinancing or purchasing, it may turn out that that is not the accurate value of the home. The second cause that could cause a pre-approved loan to fall out would be if at the time of application, the borrower can verify all the financial information they provided to the lender, but somewhere along the process, they failed to maintain that status. They could spend some of the money they were going to use for down payment. They could miss a payment on their credit report. So for both of these reasons, when either the borrower cannot initially verify the information they gave to the lender, or over time fail to maintain the information they gave to the lender, there's really nothing that the lender can do to prevent that, or the individual mortgage loan officer can do to prevent that. Now, let's talk about the other two possible causes of pre-approvals falling out in underwriting. One of those causes is that the loan officer forgot to ask the borrower a question that they should ask them. So let's, for an example, say that the borrower has indicated that they work for a family member. That's on the IRLA/1003 application. Now, the loan officer should follow up and ask if the borrower has received a large raise recently, because we do know of cases where family members will give their employee who's related to them a big raise to help them qualify for the mortgage that may or may not be a real raise. It may not continue after the closing. So if it turns out that the underwriter discovers this is what happened, they may or may not allow that loan to close. The fourth way that a pre-approved loan won't close is if the loan officer did ask the borrower the question, but were given an answer that they failed to either apply to the underwriting guideline, or they failed to realize that there could be some underwriter discretion involved with the response that was given. So say with Fannie and Freddie Mac, there are no prohibitions on a borrower obtaining a second primary residence within a 12-month period, but they do at the first closing say that they intend to stay in the property for 12 months. This question is nowhere on the EURLA/1003. So it's a question that the borrower needs to be asked, and if it's indicated that in fact, yes, they've done so, if the loan officer doesn't realize that underwriters may be uncomfortable thinking that the borrower is trying to game the system, for example, if they refinanced their primary residence last month and took $100,000 cash out, and that's the money that they want to use for the down payment on their new primary home, while they say want their children to move into their existing primary home, very few underwriters are going to go along with that arrangement. They're going to think that the borrower knew all along what they were doing when they got that cash out refinance, when they said they intended to stay in the property for 12 months. And in fact, they had no such intention at all. So where the real risk will come to the mortgage industry is if the regulators ever really get a grasp on these four reasons. Can you imagine that if the adverse action notice had to be A, B, C, or D as the reason? A, the borrower couldn't verify the information they provided at the time of application. B, the borrower could verify the information they provided at the time of application, but they didn't maintain it through the closing. C, the loan officer failed to ask the borrower a qualifying question that they should have asked. D, the loan officer was given the answer to a question and they failed to properly understand the guideline or realize there was underwriter discretion involved. Can you imagine what the penalties would be and what the regulators would do to an individual loan officer or to an individual company if they started noticing how many C's and D's they received? I'm Alan Berkovitz. I've been training new mortgage loan officers for over 30 years. It just totally disgusted me with how many consumers, let's just call it for what it is, they're flat out screwed over because either the loan officer makes a mistake or their company fails to supervise the newer loan officer and a mistake occurs. So I developed the Complete 1003 software and the Complete 1003 software educational training program to help new mortgage loan officers make sure that these mistakes don't occur. One of the groups of folks we help are people that get training, and I'm using training in quotation marks in their company, and if that training is a Zoom call where there's 30 loan officers on the call and everybody gets 2 or 3 minutes of questioning, we see a lot of loans falling out due to those C or D reasons. So if you are either a newer loan officer or a branch manager with newer folks on staff, or you're an executive or owner of a company and you'd like to see what we could do to help you prevent getting those C's and D's that as of right now, the regulators aren't tracking them, they're not fully aware of them. But if you'd like to prepare yourself for the day should that happen to occur, you can go to thecomplete1003.com, thecomplete1003.com. You can book a call with me, and I'll be happy to show you how we can help you out in that regard.